Welcome to this explainer. So, if you're carrying around this misconception that financial regulations are just, slow, boring, back-office box-checking exercises, well, prepare to have that completely shattered today. Think about it for a second. Traditionally, regulatory changes in massive financial systems take absolute years to roll out. They get bogged down in endless committees while trillions of rupees just sit in outdated structures. But not today. We are looking at a massive, rapid-fire series of mandates hitting the Indian financial ecosystem this week, right here in July 2026, and let me tell you, it is anything but boring. Honestly, it's moving at light speed.
Literally over just the last few days, the operations manual for India's trading platforms and commercial banks got completely rewritten. We aren't talking about the old days of slow compliance, right? The days where a compliance officer might literally rubber stamp a stack of paper reports 6 months after a trade actually happened. Yeah, those days are over. We're talking about sweeping, live directives from regulatory giants that are hitting base technology layers and boardroom agendas all at the exact same time.
Okay, let's dive into this. We're going to take a micro to macro journey through these updates today. First up, SEBI protecting retail assets. Second, the NSE mandating digital accessibility. Third, the RBI overhauling bank boardrooms. And finally, the real-world market impact. Let's kick things off with Section 1, SEBI, protecting retail assets.
So, let's start right on the ground floor with the Securities and Exchange Board of India, or SEBI. They've just introduced a massive operational shakeup focused directly on how your stockbroker is allowed to handle client unpaid securities. And this brilliantly illustrates the shift. Historically, brokerages could totally get away with keeping unpaid retail shares in a mixed internal pool. Now, why was that bad for you? Because they were essentially using your unpaid shares as collateral to place their own risky bets. They exploited this pooling loophole to generate what we call artificial leverage. Basically, they were borrowing against your assets to fund their own proprietary trading desks. If their bets went sour, retail assets were caught right in the crossfire. But now, that loophole is completely locked down. SEBI is introducing hard operational limits, mandating a strictly segregated client unpaid securities account, or SUSA. These are strict new safety rails that physically separate your assets from the broker's playground.
Let's actually walk through exactly how this mechanical process works in real time, because it's fascinating. Step 1. Stockbrokers must instantly route these unpaid assets into that dedicated, segregated CUSA. Step 2. The everyday retail client fails to clear their pay-in balance within the absolute, legally defined window. Now, when that alarm rings and the client misses the deadline, the broker can't negotiate. They can't hold those assets hostage to extract better terms. No, we move instantly to Step 3. The trading member is legally mandated to liquidate those specific holdings on the open market. This means the system forces a clean, automated break. What this essentially does is erase structural insolvency risks for everyday retail traders. It completely removes the broker's ability to play dangerous games with unpaid client shares just to protect the wider market.
Moving on to Section 2, NSE mandating digital accessibility.
Now let's zoom out a bit to the mid-level technology layer. The National Stock Exchange, the NSE, just issued an urgent compliance guideline executing the strict mandates of the Rights of Persons with Disabilities Act. And when I say urgent, I really mean it. Look at this date, July 31st, 2026. That is a hard, absolute end-of-month deadline for all active trading members. To give you an idea of the sheer panic this is probably causing in tech departments across the country, we're talking about tens of thousands of lines of complex trading code that have to be audited and potentially completely rewritten by this exact date. They have to submit their final accessibility audit report for their digital platforms. There is absolutely zero wiggle room here. So, how do brokerages actually comply with this? Well, there are two distinct compliance paths for trading apps, and it depends entirely on how they're built. If a brokerage is using standard off-the-shelf vendor applications, they can simply submit a standardized vendor compliance certificate. It's fairly straightforward, mostly because the heavy lifting was already done by the software vendor. However, if a brokerage is using unique, in-house customized apps or websites, that requires a completely independent, highly specialized audit. Why? Because custom code means custom vulnerabilities and unique interface quirks that an off-the-shelf checklist just won't catch. Missing this July 31st date on either path triggers immediate system audit validation flags. And let me tell you, that could effectively paralyze a broker's digital operations. You absolutely do not want those flags on your systems.
Just to be perfectly clear on the actual scope of this mandate, every single customer-facing piece of tech must be audited. We're talking everything. This spans from mobile trading apps to eKYC onboarding portals. By the way, that stands for Electronic Know Your Customer. It's just the digital process platforms use to verify your identity when you sign up. But it also covers web interfaces and even back-office portals. And it can't just be, any internal IT employee checking a box. It has to be done by a certified International Association of Accessibility Professionals, or IAAP auditor. The NSE is stepping up to make sure the tech is genuinely, functionally accessible, to protect and empower investors with disabilities. Which brings us to Section 3, RBI, Overhauling Bank Boardrooms. Ascending now to the macro level, let's shift our focus directly to the banking infrastructure itself. The Reserve Bank of India, the RBI, has issued a structural governance order that fundamentally changes how commercial banks, small finance banks, and payments banks operate at the absolute highest level. Now, what's really interesting about this slide is the contrast. Imagine highly paid bank directors sitting around in a boardroom, wasting valuable hours debating low-level administrative checklists or, nitpicking the font size of compliance sheets. The old policy relied on a rigid, 7-broad-theme reporting framework that actively encouraged exactly that kind of micromanagement. Well, the RBI is stepping in and completely stripping that away. They are replacing those tedious checklists entirely with high-level, principle-based guidance. They are legally forcing a massive pivot in the boardroom agenda.
With this new principle-based guidance, directors can no longer hide behind mountains of trivial paperwork. It's just not an option. They are now mandated to focus their sessions entirely on 3 core areas: deep macro strategy, core asset quality risks, and technological vulnerability safeguards. Let's break that down for a second. A failure in macro strategy. That could mean a bank completely misreads inflation trends and crashes its entire lending portfolio. A technological vulnerability might be a single unpatched server that leads to a massive cyber attack on a banking portal. By clearing out all the administrative noise, the RBI is ensuring directors are looking for these massive existential threats. This means directors are now personally accountable for failing to spot systemic credit risks or infrastructure gaps early.
Finally, Section 4, the real-world market impact.
So let's recap. We've covered the ground floor with SEBI, the tech layer with the NSE, and the macro boardroom level with the RBI. Let's synthesize all of these updates and examine the immediate, structural takeaways for the Indian financial sector. For listed discount brokers and heavily tech-dependent trading platforms, think your major players like Angel One, Grow, and Zerodha, the impact is immediate. Over the next 2 weeks, the technical teams at these major platforms are going to face a massive surge in compliance overhead costs. They are quite literally in a race against the clock to patch their interface layers to achieve that strict IAAP compliance before the end of the month. But what does this actually mean for you, the consumer? Well, while it might temporarily spike operating costs for these platforms, it ultimately means the ecosystem you use to trade and store your hard-earned wealth will finally be safer, more accessible, and vastly more transparent.
If you want one core takeaway from this entire explainer, it is this. The entire Indian regulatory ecosystem is rapidly, fundamentally shifting its posture. We are moving away from an era of just slapping wrists with retroactive penalties long after something goes wrong. We're done with that. We are now in an era of live, code-level, and board-level systemic hardening. What we are seeing today aren't just a bunch of isolated events. It is a synchronized regulatory net being cast over the entire financial system. From SEBI strictly locking down unpaid client securities, to the NSE forcing inclusive digital accessibility, all the way to the RBI making bank directors personally accountable for deep strategy, the system is hardening its defenses in real time to protect everyday users.
Which brings us to the ultimate question for absolutely anyone participating in this market. Take a look at the platforms handling your money right now. Seriously, think about it. Is your brokerage ready for code-level accountability, or are your assets at risk? It is definitely time to make sure the platforms you trust are fully compliant with these massive new mandates. Keep an eye on those compliance sheets, stay asset safe, and I absolutely cannot wait to dive into our next expert analysis with you. See you then!